Most people believe real estate creates wealth because property prices go up. That belief sounds reasonable, but it's incomplete. And because of that, it leads many people to make poor decisions even during good markets. Here's the uncomfortable truth most people don't like hearing. Price growth alone does not make you wealthy in real estate. In fact, relying on price growth is one of the fastest ways to take unnecessary risks. If rising prices were all it took, then everyone who bought property over the last few decades would be wealthy. But we know that's not true. Some people own property for years and barely move forward financially, while others quietly build significant wealth with properties that don't look special at all. So the real question isn't whether real estate works. The real question is how it works, mechanically, financially, and over time. And that's what we're going to break down today. By the end of this video, you'll understand how real estate actually creates wealth beneath the surface. Not the social media version, not the hype, and not the lottery-style thinking, but the real system that has worked for decades across different markets, different cycles, and different interest rate environments. And once you understand that system, you'll also understand why many smart, hardworking people still struggle with property, even when markets rise. To understand how real estate creates wealth, we first need to understand what kind of market real estate actually is. Real estate is not a fast market. It doesn't move like stocks or crypto. It's slow, heavily regulated, and deeply tied to credit. And that slowness is not a weakness. It's actually part of why wealth can be built through it. At the center of the real estate market is lending. Most property transactions depend on borrowed money. That means interest rates don't just affect affordability, they affect demand, prices, investor behavior, and even which types of properties succeed or fail. When interest rates are low, borrowing is easier. More people qualify for loans, purchasing power increases, and prices tend to rise because more money is competing for the same limited supply of property. When interest rates rise, demand cools, price growth slows or reverses, and weaker investors are forced to exit. This isn't random, it's cause and effect. Now add inflation to this system. Inflation quietly reduces the value of money over time, but it doesn't reduce the value of physical assets in the same way. In many cases, it increases replacement costs, labor, materials, land, which supports property values in the long run. At the same time, rents tend to move upward with inflation because people still need housing regardless of economic conditions. That's a critical point many people miss. Supply and demand also play a huge role. Housing supply is slow to increase. It takes years to plan, approve, and build new properties. Demand, on the other hand, can change quickly due to population growth, migration, employment shifts, or lending conditions. This imbalance, slow supply and flexible demand, is a major reason real estate behaves the way it does over time. So when we talk about wealth creation in real estate, we're not talking about luck. We're talking about operating inside a system shaped by credit, inflation, supply constraints, and human necessity. And now we can talk about how wealth is actually created within that system. Real estate creates wealth through multiple forces working together over time. Not one, not two, but a combination that compounds slowly and steadily. The first force is cash flow. Cash flow is the difference between what a property earns and what it costs to operate and finance. Positive cash flow means the property supports itself. It doesn't drain your personal income. And while cash flow alone won't usually make someone rich quickly, it does something more important. It keeps you in the game. Cash flow gives you staying power. It allows you to hold property through market cycles instead of being forced to sell at the wrong time. The second force is leverage. Real estate allows you to control a large asset with a relatively small amount of your own money. This is neither good nor bad on its own. It's a tool. When used carefully, leverage magnifies long-term returns. When used aggressively or blindly, it magnifies mistakes. But here's what matters. If a property grows in value over time, the growth applies to the entire property value, not just your initial cash. Meanwhile, your loan balance typically reduces slowly as tenants help pay it down. That combination, asset growth plus debt reduction, is one of the quiet engines of real estate wealth. The third force is inflation. Inflation works against savers, but it often works in favor of borrowers who hold long-term fixed assets. Over time, the real value of debt shrinks, while rents and property values tend to adjust upward. This means that the same loan payment becomes easier to manage in real terms over the years, while the asset continues to exist and produce income. The fourth force is time. Real estate rewards patience more than precision. Most of the wealth created through property doesn't happen in the first year or even the first 5 years. It happens in the later years, when loans are smaller, rents are higher, and the market has had time to move through multiple cycles. And this is where many people misunderstand real estate. They focus on short-term price movement instead of long-term structural advantage. The advantage isn't speed. The advantage is durability. If real estate works the way we just described, then why do so many people struggle with it? The answer is psychology. Many people approach property emotionally instead of structurally. They buy based on excitement, fear of missing out, or social pressure. They overpay because prices are rising, or they freeze because prices might fall. Fear causes people to wait endlessly for the perfect moment that never arrives. Greed causes people to stretch too far, use too much leverage, or chase unrealistic returns. Impatience is especially dangerous. Real estate is slow by nature, but people expect fast results. When progress feels boring, they assume something is wrong. Another common mistake is confusing speculation with investing. Speculation relies on future price increases to justify today's decision. Investing relies on the property's ability to survive and function even if prices don't move for years. Smart people also fall into the trap of overconfidence. They assume rising markets validate bad decisions, but markets don't reward skill evenly. They often hide mistakes until conditions change. And when conditions do change, only structurally sound decisions survive. Instead of thinking about real estate as a way to get rich, a better framework is to think of it as a system for converting time, discipline, and capital into durable wealth. A long-term investor asks different questions. Not how fast will this go up, but can this property support itself if conditions change? Not what's the maximum I can borrow, but what level of debt keeps me flexible? Not what did prices do last year, but what fundamentals will still exist in 10 years. This framework doesn't eliminate risk. Nothing does, but it shifts risk from emotional decisions to manageable variables. Real estate wealth isn't built by predicting the future. It's built by structuring decisions so that multiple outcomes still work. When you look at real estate over 10 or 20 years, patterns become clearer. Markets rise, fall, stagnate, and recover. Interest rates change. Governments adjust policies, but housing remains essential. People still need places to live. Businesses still need space. Over long periods, wealth tends to accumulate not because of perfect timing, but because of consistent ownership of productive assets. Patience allows compounding to do its work. Discipline prevents overreaction, and time smooths out short-term volatility. Most people overestimate what real estate can do in 2 years and underestimate what it can do in 20 years. So how does real estate really create wealth? Not through hype, not through luck, not through constant buying and selling. It creates wealth through a slow system where cash flow supports ownership, leverage magnifies time, inflation quietly reduces debt, and patience allows compounding to work. The real advantage of real estate isn't speed, it's durability. If you understand that, you stop chasing excitement and start building structure. And structure, over time, is what turns ordinary properties into extraordinary outcomes. Real estate rewards those who respect time, manage risk, and stay disciplined long after the excitement fades. That's how wealth is actually created, and that understanding alone already puts you ahead of most people in the market.